Okay, we're on the last session for the day, and then afterwards we have drinks. So you've got half an hour. And the last half an hour is by Hayley, who was here with us this morning, who will talk through presentation and disclosures. And I think she's joined by Kenatu, who is a senior manager that she works with. Sorry, that was my fun.
I can start. Okay, I'll just get started. Let's check I'm working. Okay, perfect. Last session of the day, I get all the good slots, as I said earlier. So I'm happy to be back. We're going to have a little bit of a talk about presentation and disclosure. I am going to pass the majority of the session to my colleague Ken, who has extensive experience in actually preparing the disclosures. But before I do that, just like I did earlier today, I just want to give you an overview, I guess, of the things that I think you need to be thinking about now. Over about the last year, I've run a number of training sessions for boards on this standard and on the potential impact to them. I think what's really important now is that they have the basic knowledge and a basic understanding. What they really are wanting to see now is, what does this look and feel like for them? What are their new financial statements actually going to look like? So the boards are now coming back saying, okay, you've given us a general overview, that's great. What does this mean for us? Show us what our financial statements are actually going to look like. And what that's doing is then putting pressure on management to actually be preparing a pro forma set of financial statements that boards can actually look at. So I think my colleagues Janine and Glenn mentioned earlier today that taking a look back approach and saying, well, what is the data that we need to actually feed into the financial statements, that actually links to that point that I'm making around actually putting the pro formas together, seeing what the disclosures actually are going to look like, what data that you're actually going to need to feed into those disclosures, and making sure that's a part of your project nice and early. Even for general insurers that do all this work and end up with PAA eligibility still, and not a significant change, I guess, to what they're actually doing today under 23, the thing that is still going to change is your financial statements. They are going to look completely different than what you have today. So it's really important that everybody understands that and is working through that impact. Another important element, I think, of disclosure and presentation is this is not a problem for just the first year that you adopt the standard. So actually in the year before you adopt the standard, the accounting standards actually require that you disclose the impact of the new standard. So you actually need to be thinking a year ahead when you're doing your diagnostic, and I'm sure that obviously that's a big discussion for today around what the potential impact is. There needs to be a disclosure on the impact of the standard, and I would expect that a part of that is actually talking about the new disclosure requirements and the kind of information that is actually going to be included in your financial statements. So I'm just going to hand it over to Ken now. He's actually more scary than I am, so be ready for the frightening onslaught of disclosure requirements.
Thanks, Hayley. Thanks, Hayley. All right, so today we heard a lot about the theoretical concepts that I've listed up there, and I won't go through them because I don't want to tell you about them. What I'm trying to achieve out of this session is to show you. So when it's all said and done, all of that work that we need to do, the accounting policies, the actuarial work, the data systems, the tech that we talked about, at the end of the day, it all flows up to here, the financial statements and the disclosures. This is our businesses represented through numbers to tell a story, okay? Yet, for all their importance to you will depend on what kind of insurer you are. So let's, for example, say that you're an unlisted mutual health insurer, right? You care about the members. What's good for the members? Your performance metrics are aligned to what the member benefits will be. To an extent, if you're running your IFRS 17 program, you almost want to shield the raw business from IFRS 17. You want to let the business get on with doing what's important to them. If, on the other hand, you're a large multinational listed insurer, then you'll be highly sensitive to what comes out of your financial statements and disclosures. Your CFOs and CEOs live and die by their ability to link management actions to financial statements outcomes. So as important as they are and all the work that goes into them, you still need to put that in context of who you are and what's important to you. All right, so start here simply at the P&L. I will use these terms a little bit interchangeably. So we've heard a little bit more about the terms. We've had 2 separate sessions on the terms that are coming out of this standard. And the key outcome here is that the language of financial performance is changing. A lot of those terms that we know and love now, a lot of them will not appear on the new financial statements. The way that you talk about financial performance, both externally and internally, is likely to change. So here I've got a little bit of an example of what those 3 standards might look if you've lined up. Now I have a general insurance background, which I think matches most of you, which is good. So I'll talk mainly about 1023 verse 17. Okay. So as I showed you on the previous slide, probably the only 2 lines that are going to look very, very similar will be the top and the bottom when you get to profit. So not only are the language of the terms different, but the philosophy of this standard is fundamentally different from 1023. So 1023 typically looks at what kind of premium do we get in, what kind of reinsurance do we take out, and what's our net premium. They then talk about what the claims we pay out, what kind of reinsurance recoveries we get back in, and what's our net incurred costs, and then we get down to our net profit. Now, IFRS 17, as was told by the ASB, has a fundamentally different way of looking at your insurance contracts in two distinct groups. First of all, there is what's coming in for gross, what's going out for gross, and then you have a result, almost a mini P&L for your gross business. Under that, I've shown it only as 1 line for your reinsurance, but equally you could show it as 2. You almost have a mini P&L for reinsurance. Underneath, what sits that is all your investment activities, or your investment income, or your discount unwind, and then you have a net financial result. You have a mini P&L for your investment business. These 3 P&Ls culminate to the new term that you're looking at in terms of insurance service results, and then finally down to profit after tax. Okay? So it's quite different. Now, what I've shown here is an illustrative example. Your own choice in terms of presentation disclosures could look very different. I'm just showing here an example. And I've shown you a very simplified example because the net profit after tax, I've made that the same. Now, for a lot of the general insurers who utilize the PAA for all direct and all reinsurance, this is not an unreasonable outcome for general insurance. For life insurance, this is probably a bit of a fantasy, sorry. All right, on to the balance sheet. Okay. So again, there's a fundamental difference in the way that this standard actually lays out your assets and liabilities. So in the middle, there's many of the terms that you know and love right now. But on the right, it groups assets and liabilities together. Whether they're direct insurance contracts or reinsurance contracts held, if they are assets, they're up there on the top. Same on the liability side. If they're direct contracts or reinsurance contracts, they're grouped down there at the bottom on the liability side. Okay. So this is what it might look like for 1023 verse 17. So the first thing that you can notice, and we've talked about this a little bit before some of the other speakers, that you have relatively less transparency. A lot of the items on the assets and liability side have been moved, netted off against each other to create a much thinner balance sheet. Okay? So particularly for general insurance, what you are probably going to see is that your total assets position will fall and your total liabilities position will fall, but it's not unreasonable to expect that your net asset position might actually remain the same. Principally, one of the key drivers behind that is premiums outstanding. So your premiums outstanding was previously an asset. It's now going to go on the other side of your balance sheet and be a negative liability. So while your net asset position might actually be the same, you actually will see a total asset and total liability fall. Now that might be important to your organization if you have arrangements or structures that look at total assets or total liabilities. So I'm aware that some debt obligations could rely on total assets or total liabilities. Some of them just rely on net assets. So that is something to be aware of if you're a general insurer about the movement on the balance sheet. Okay, so now that we've seen the new P&L and the balance sheet, and you've seen that it's relatively much thinner and has less transparency. Where is all this scary disclosure and data, where is it all hiding? Well, it's hiding here. Okay, so what I'm going to start with is the new roll forward disclosure that's just for the PAA. I will talk about general model and VFA separately, but a lot of the key concepts are here on this page. So the first thing I want you to do is be horrified with the number of numbers that are up here. The second thing I want you to have a look at is the colors I've added in. These colors are not mandated by the standard. It's a principles-based standard. So the top and the bottom, kind of looks like a gray to me, they are balance sheet items. And the total on the very right, that needs to tie to the face of your balance sheet. The items in blue, they are your P&L items. The columns on the right in the total will need to tie to the face of your P&L. And most fun of all is the items in orange, your cash flow statement. So this PAA roll forward is now going to mandate that you do a three-way reconciliation of your three key financial statements and raise them up to the level of your financial statements and disclosures. So when I talk to a lot of the finance people, typically they're not bad at recognizing and reconciling P&L and balance sheet. When it comes to cash flows, I generally get a sheepish, oh, yeah, it kind of works, sort of, maybe. This standard is going to enforce a level of discipline for most general insurers, which previously has not existed. Now, to be fair to the ASB and ISB, there is actually quite a nice discipline with the way this is laid out. You have an opening set of assets and liabilities. You have profit that occurs, claims, premiums. To the extent that you get paid or pay out for those items, the remainder and the residual sits in the bottom. So even though it's operationally very painful and very difficult, there is actually a nice discipline with this.
And that's the really common question. Well, hang on, how do I get the data to actually go into this model?
Yes, that's right.
And that's really the biggest challenge. Anybody can put a table together, right? But how do you actually populate it?
That's right. So normally this is enough to scare people, at least a little bit, because you should have all these numbers, but getting the numbers in the right time and the right granularity to make this happen is the challenge. Because don't forget, you need this one for direct and one for reinsurance. If you're a bigger organization and you determine that your reporting segments are more than one, you will need N number of these disclosures for direct and reinsurance. Okay? So I'll walk through this briefly. I don't intend to walk through the numbers. On the left-hand side, you've got liability for remaining coverage. So in our world, UPR, or the unearned portion, are those two columns. On the right-hand side, you've got liability for incurred claims. That nome is a bit of a misnomer. It's actually liability for incurred claims and incurred costs. So your OPEX, for example, will sit in the third column there. And then, of course, you've got totals. Now, what's particularly interesting, of course, is that second column, the onerous contracts component. So we've talked a lot about, particularly in the last session, with some difficult questions in terms of the loss component. This is where that you are going to see that come through. And because the P&L and the balance sheet have relatively less transparency, if I put my investment analyst hat on, this is the disclosure that I'm going to really understand what's going on under the hood of an insurer. Okay? All the detail is here that you can see. All right. So I might just move now to what those disclosures would look like for GMM and VFA. Okay? So this first slide here is very, very similar to the one that we just covered. In this particular choice of disclosure, we have not disaggregated risk adjustment and the central estimate because all of that lovely detail about the risk adjustment will now be this additional roll forward. So this is an additional roll forward that you will only require if you do the GMM or VFA, so everything that's not the PAA. And this is essentially another fourth dimension to your reconciliation. You will now need to actually reconcile a lot of the actuarial items. So if you look at the words and the lines there, they're typically actuarial and claims-related items. You will now need to reconcile this across those dimensions. And of course, it has to tie back to your other roll forwards. All right, so some closing comments. The language of your financial statements is changing, and depending on your organization, that might be a big change, that might be a little change, okay? Alignment through your organization, through internal management reporting, KPIs, is something that you should think about if you're particularly a listed insurer and you want all of your organization to be pointing to the metrics that the CEO and the CFO will be talking about. Start with the end in mind. So that's what was said previously, and I find that often when we put this in front of non-technical people, it helps them understand and give them a view or an illustration of what the new world would look like. And as you go back through and perform this exercise, which I thoroughly encourage you all to do, you'll realize what data you do and you don't have. And so doing this exercise and even asking the questions, do I have that piece of data? Do I have it at the right level of aggregation? Can I get it easily? Those kind of questions as you go through this exercise will help you understand what the weaknesses are in your current gaps and help you frame the IFRS 17 problem that's ahead of you. Okay. Data capture and data management is obviously very, very critical. There's lots of numbers, they all need to reconcile, and if you're trying to close your books in a very fast fashion, then this is going to be very, very important for you to set all those systems up before you need to report. If you have a month to close your books, that's fine. You've got time to walk over to Bob and ask about reinsurance premiums and talk to Sarah, your actuary, and get the natural hazards numbers. But if you want to close in working day 3, you need all this in a touch of a button. Otherwise, it's not going to reconcile. IFRS 17 is not finalized yet, so while we are hopeful that the standard will be finalized in 30 June next year, the standard is still evolving, and there's a few nuances to that. So first of all, internationally, the standard is still evolving. Obviously, the standard is evolving. But probably more importantly, the local practice, your peers, the peers in this room, your interpretation and your industry standard is still evolving. So I will echo the point that Jenna from Suncorp put out before in terms of getting involved in forums and trying to help drive some consistency in the industry. It will help you all if you're landing at exactly the same point. Okay? But what that also means is that you need to keep an eye on what this looks like as you make accounting policy and accounting choices. And this helps you keep the end in mind. As you make choices to elect DAC or no DAC, for example, being able to flow this through on a continuous control cycle basis will help you understand what exactly that's going to mean for your organization. And last but not least, obviously, IFRS 17 is going to bring a lot of operational complexity. And as you saw from the roll forward, there's a real mixture of items there. There's factual information from your policy systems, your premiums. There's finance data like expenses, and obviously you've got actuarial data such as expected claims. All of your functions are now going to need to work together very, very closely to make sure that those numbers reconcile, and they're also able to pull meaning out from the financial statements and understand what's happened throughout the year. That's my last slide. I'll open up for questions.
Yeah, probably just 2 things from me as well. Obviously, the examples that Ken's shown don't cover IFRS 9, which I covered earlier today, but there's obviously new extensive requirements around that depending on how you classify your assets and if you need to apply a impairment model. So that obviously make things quite difficult. 2 would be, early discussions with your auditor, making sure that they're comfortable with your pro forma statements, and so that you're not in the situation where you're adopting this standard and your auditors haven't seen what your financial statements are going to look like and think you're missing half the disclosures that you require. And all of this in the context of, I'm sure, the board's saying you should apply disclosure effectiveness at the same time and keep your financials as succinct and easy to read as possible.
Are there any questions? No questions. Right, everyone wants to go to drinks. Fair enough. Don't blame you.